following program contains views that are not those of WVTC, iNetworks Communications, their subsidiaries, affiliates, or financial supporters.
Go to your Apple or Google Play Store and download the WVTC Gospel Radio app today. You can also say, Alexa, play WVTC Radio Skills.
Would you like to play WVTC Radio Network?
Absolutely. Download it today.
Man, why you cut that off? How you doing, guys? Brian Sewell here. The mortgage doctor is back. It's good to say that. I got a special guest, Christian Willis, here with me. How you doing, Christian?
Hey, how you doing?
Good. My good partners, producers, cut this song right when you hit. I love that song, man. What CC's like, you said it. I believe that's the call for us, right? They got so many inspirational books out here, so many things. But I mean, like for me, the words of you said, and I believe, I love it. So, yeah. So Brian Sewell here, the mortgage doctor. You know, been away from you for a little while. Please share the show. We're going to talk a lot of cool things today. You know, one of the topics that I'm going to hit, which I'll talk about a little bit more, but I'm going to give you the purpose of this show. The purpose of this show is to help everyone build wealth through the American dream of home ownership, right? And how you do that is explaining all the things that's available to you, bust some myths and all those things. I like to call that with our 3 E's. Right? We're going to educate you, we're going to encourage you, and we're going to empower you. And those 3 E's, the education piece, is when I bring on different guests like Christian here to give you what's really true out there, right? The encouragement comes from because I truly believe that buying a home is a top 5 decision that you make in your life. We'll discuss that later. And I think that you don't want to leave that decision up to someone that's strictly just motivated by money. And that will give you empowerment to make a good decision. So even with saying that, Christian, it's good to get you on the show. How you doing? We've been talking about getting you on for a little while.
I'm good. How are you?
Good.
Good.
Christian, give the audience a little bit of a background on yourself, of who you are and all that jazz.
My name is Kristen Willis. I'm a real estate agent. I've been a real estate agent for 5 years now. I'm from the south side of Chicago, and I specialize in residential real estate.
Cool. And you do a good job. I've known you for a few years now. It's funny how the years just start to fly by, right?
I really do.
Yep. So, and I've asked you this before, but why'd you get into business? What's your drive behind real estate?
My drive is just helping people. I love to help people. I love to see the impact that I'm making into people's lives by helping them get into real estate.
Yep.
And educating them at the same time.
Yep. So look, the impact, you know, so much wealth is built through home ownership, and we're going to show a couple of different things. David, hey Dave, how you doing? We got a Black Coffee. Let's go ahead and call him Guy Black Coffee. I know who you are. How you doing, brother? Hey, really quick, can we turn our mic up because they're saying they can't hear her? So let's make sure we do that. And then,
Am I supposed to be speaking into the mic?
yeah, you got to speak into the mic a little bit. Testing 1, 2, 3.
I don't
So
know if it's on or not.
let us know, Dave. Let us know if you can hear a little bit better once you see it. Good old Dave Weiner. He's a really good dude. You guys know he comes on the show with me from time to time. So you talked about that purpose, right? You know, just kind of speak to that one more time. So, and I know just in case people didn't hear you.
About why I got into
Yeah,
real
why you
estate.
got in? I want you to repeat that what you said
I
there.
got into real estate to help people to be an impact,
Hmm.
to educate people in my community and people that look like me on real estate,
I
and
like
just
that.
being a part of their journey of elevating.
So it's funny you say that, and I don't want to jump right into that. We're going to jump back and we're going to interview you and stuff like that. But I like what you said of people that look like you. I mean, like at the end of the day, because I like to help everyone, but I want to speak specifically to us, to
Yeah.
our people, right?
Mm-hmm.
So I think sometimes we hear things or we just assume things and we just go along with it,
Right.
and then our people aren't taken care of the right way.
Yeah.
And I want to let more people jump on the show because one of the things that I talked about, we're going to get Christian rolling here in a second, that why that zero down program is not always the best option for people. We hear so many things, and like growing up, I grew up on the south side of Chicago, south side, right?
Mm-hmm.
And I grew up West Pullman, right? And a lot of times what I saw, I don't even think they're around anymore. What was the big car company on 140 something? Was it Bob Watson or I'm trying to remember, but they would always sell like these zero down things, the motivation behind it. And for those that grew up on the south side, you know what I'm talking about. I think they're right on Harvey. You see all these commercial. Yeah, Bob Watson, it was like gimmicks and stuff like that. And again, I'm not saying that, look, there's reasons, we can talk about those too, why we need that assistance and help, right? Because we didn't get it. We didn't like a lot. We started off with call it an arm behind our back, and I'm being nice, right? But also we got to understand the wealth part of real estate and how understanding everything. And sometimes you might make a decision whether that's the right program or not for you. We're not just going to talk about it, but it's making sure that you're fully advised. You have all your options so you can make a good decision.
Right. So are you saying that the 0% down is not a good option?
And
Do you not suggest that? Because I do see a lot of realtors and lenders that make that, they advertise that on social media. What's
Yeah.
the period about the 0% down?
So yeah.
So yeah.
So I can talk about it. So I was trying to. So I don't believe it's the best option for most people. Now each situation is different.
Okay.
And I'm gonna tell you why. So we're gonna show building wealth and things like that. And not saying, look, doing 0% financing, if there really is such a thing, is better than you paying rent. So let's get that out the way.
Okay.
If you're in a situation where you're paying $1,500, $2,000 a month in rent, and you need a leg up to help you get in, then it might make sense. The reason that I say it may not be the best option for you is, number one, you pay a higher interest rate.
Okay.
And in some cases, so I'll give you an example. I love examples, easy math, guys. So I had a client about 2 weeks ago that was looking at a property, was thinking about doing zero down, and the property was $240,000. And I'm going to do general math. That payment on a zero down, because they talked to another loan officer before me, was about $150 more a month, not including the money they had to pay back. So they had to pay back this grant. It was like $95 or $100 more a month. So let's just call it $250. So you're going into a house paying $250 more. So you got to ask yourself, is the cash flow make sense? The other issue that I have, and no one can predict rates, is that we're in a lower rate environment. So this client was able to get 6.5 doing a regular loan, or they would have got 7.5 doing a zero down program. Okay, which made their payment a couple $100 more, $240 more. The third issue is this: the government announced, the Fed announced about a month ago that they're going to cut rates 2 or 3 times this year. So if we're in an environment 6 months from now or a year from now where rates are in the mid 5s, again, we said 7.5, and this was like close to a $300,000, probably like 250, 280. I don't remember exact numbers. Overall, it would have been about $340 more a month that they would have saved overall if they're able to refinance later on. In addition to that, they would have had to pay back that grant. So I'll ask the question: if you're in a situation where you could put 3% down or 3.5% down, or you put less money down, but you got to pay back that grant and you're paying a higher rate and you're stuck in it, is it really the best option for you? And maybe you're at that situation where you'll say, well, I have no money, Brian, I need to get out. Then we need to properly prepare you. But it might make sense, in my opinion, 1 out of 20, 1 out of 50. But if you're going into it knowing rates are coming down and you're stuck and you're going to be paying a higher interest rate, I won't be too happy about that. That's my opinion about it. But I also think we got to come from the wealth side of this. So we're going to show some more stuff. But what are your thoughts on that?
I think because it's advertised so much, and it, people don't really like everything costs, and so people don't really think about that. Like they just think you're gonna get free money.
Oh yeah, it's
So
not
that's
free.
not being advertised with the down payment assistance and all the programs, that those things do cost you. So if you can properly prepare yourself to be in a better situation, then obviously that's better. But you do get a lot of first time home buyers who don't have all the money to put down. So like, what do you advise for them? Those that don't really have the funds to put down, the credit score is low, because then you get in situations where people don't understand that you have to qualify for down payment assistance.
You do.
You can't have a low score and get down payment assistance. So kind of talk about those first time home buyers that have like a lower score and they, they really don't have the funds for down payment or closing costs.
Right. So we put them in our little, we call it our CRM, and we help them. We help cultivate those clients.
Okay.
I'm all about, and so I always, part of the show is education, encouragement, empowerment. So I believe in coaching. Like I get coached. You hear me talk about that. We do lunch and learns, right?
Right.
So I truly believe in educating our clients. And the thing is, you need to be able to understand the numbers and be able to look at the numbers and make sure they make sense. So first of all, let's put a budget together.
Okay.
Everyone can go. We've all been there, unless you were born with a silver spoon and your name is Hilton, right? I'm calling you, you have to work, right? So can we put you in a situation to help properly prepare you? Now, if you got to rush out, you need to move, because life is going to happen, right? Life's going to hit you. And when life hits you, regardless of what program and things you're in, if you're not properly prepared, you can be setting yourself up to lose your home later on.
Right.
And speaking right on to that, Black home ownership, it gets hits the worst all of the time.
Yeah.
Like when 2008 happened, it hurt everyone, but it hurt us more. When this situation happened last year, it hurt us more. When COVID happened, it hurt. So that is not getting addressed, or sometimes we go with what's quick and what's being advertised. So with somebody with a low credit score, is there possibility? Could it be that if I took 30 days and worked with somebody that cares about my credit, or 60 days with my credit, could I get my score up higher and be in a better situation? Or, is there a situation where I can save more? And we're doing a plan. So everybody's situation is different. So let's I'll use the IDA grant, which I like that grant a little bit better. Now, in this environment, okay, you will still have to pay back that grant if it's time to refinance, right? Because no one's talking about projection. We're just looking at things right now.
Yeah, right.
Everything we talk about, Christian, you and I talk about this, about our business plan. If I just look at what I'm going to do for the next 6 months or the next year, that's important. But I need to see what we're doing in the next 5 years, the next 10 years, next 15 years. Mm-hmm. So would IDA make sense for them? Well, IDA wants you to have a 640 credit score. Okay. They will ask you to pay back that grant if you refinance within the first 5 years or 10 years, depending on which program you do. Right. I truly believe in this market. If you truly want, you're going to probably be refinancing within 6 months to a year, maybe, or sooner in some cases. So I would actually advise the client, let's do a mortgage plan. Let's do a budget and look at a plan. And it's not saying we don't help them get into a house. It's just saying, let's make sure we keep them in the house.
Exactly. Yeah.
So, I mean, and I know you teach your clients the same way. You educate your clients. So that doesn't mean we don't want to help people do it. Like, look, we understand. We just go back and address that elephant in the room. You're starting off with a hand behind your back. Some of our other race friends, they get a heads up.
Yeah, they have.
Right.
They have already had a head start.
Right. And some of it, like, and I'll just be completely transparent. Like, my kids have a heads up than I did. Mm-hmm. Because but I learned about it financially early, and I began to save. Part of a budget and things that we could do is, like, I remember reading Rich Dad Poor Dad a long time ago, 23 years ago. And one of the things they talked about in cash flow, I think it was, is 10% to giving, 10% saving, 10% investing. So you hear me say that, I still learned that principle, right? So can I put a budget around that? I talked to a young lady today that, and I shouldn't say young lady, she was I think 48, 49, something like that. But she was talking about she's going to sell her house. She's going to walk away. So she didn't get her dream house first. She lived in that house for like 15 years, 10, 15 years. But she's selling her house. She got like 150,000 in equity, not by the money she put down. She only put down like 35%, but she's going to sell it. And now she wants to buy a bigger house. Okay. But the thing is, like, she's like, I want something a little bit. She want to build wealth a little bit more, and she's like, well, I got this car note. The car note was like $1,100. So I'm telling her business. No, I'm not telling her name. And she's like, you know what I'll do? I owe $35,000. I'm going to sell the house and pay off that car. She came over. I would have went over it with it. And then that way I can afford the house. So we took her from a $400,000 pre-approval to a $500,000 pre-approval. Okay. But I want to show you what that wealth looks like. Okay. So I don't want to complicate it, but we're not avoiding this zero down. Look, If it gets you in the door, fine. But make sure you understand that financially, you're not being put in a situation. You're gonna be. You and I go to a house together. We got the exact same credit, same situation. Let's say I got 3.5% in the bank. You got 3.5% in the bank.
Right.
What's a retirement? You go 0 down. I go 3%, 3.5% down.
Mm-hmm.
I'm at a 6.5 rate. You're at a 7.5 rate, and you're paying back a loan. That scenario, you're paying $240 more a month. Rates come down to 5.5%. I can refinance and drop my payment even more.
Right.
You can't,
Right.
because you got to pay back that loan.
Right.
Or you might be able to pay back the loan, but you're gonna be in a higher situation. So I would rather be able to give you better cash flow again, but in certain situations makes sense. Now, if we go over all these numbers and you decide what you want to do, 100% your decision. I still say buying a home is better than renting.
Okay.
I don't know if that makes sense, guys. Come on, let us get some feedback. We're just talking.
Sense.
He ain't trying to help us. She ain't trying to. No, we want to help you. We just want you to know all the facts. Like that idea?
Yeah.
So I didn't say I hated it. I just said it needs to be explained, because what you're seeing it on social, right?
Yeah, I do.
It's getting pushed a lot.
Yeah.
Do they talk?
No, they don't talk about it. And then they don't even talk about some people that can't even qualify for those down payment assistance.
Well, they have debt ratio restrictions. So another thing, I don't know, did you want to say something else on that?
Oh, I was just saying, like, people,
Yeah.
sometimes you can make too much money to even qualify for the down payment assistance.
Right.
So then that knocks you out of that as well.
Right, and it's better. I mean, now again, I'm going to talk about a program that we have. It's not 0 down, but it's low down payment, but you don't pay back the grant. So can we define what a grant is? I mean, just for like our purpose, we don't get Webster Dictionary, but what do you think when I say grant? What do you think of?
When people hear a grant, they have free money.
Free, FREE,
right? To be paid back.
Right. So I have a grant that now there's an income qualification on it, that first of all, we have over 700 first-time buyers programs. We are the #1 first-time buyer lender.
Really?
Yes, we are in the country. So when Cherry Creek merged with Gill as of April 2nd of last year, we keep about 90% of our mortgages. It opened up more first-time buyer programs. We were the first ones to come out with that 0 down program.
Okay.
I just don't promote it as much because I truly don't believe in it as much, because I don't think it helps people as much. I think it helps if you're a renter and you're tight, but in this environment, it's different. Now, if we were in an environment where rates were going up and we didn't see like what we were about a year ago, they kept raising rates,
right,
then it's not that big of, but it's still, you're still paying a higher interest rate.
Right.
Like when you do, like sometimes when you buy a car, right?
Mm-hmm.
It's like if you wait, I haven't done this in a while, but let's say your credit is not good, you're paying a higher interest rate compared if you take a few months or something to work on your credit, you're paying a lower interest rate.
Right.
All right. So that's kind of the concept of it. You explained about that why people may not qualify. You want to? I mean, you can elaborate on that, because I can piggyback on what you were saying.
I just see that sometimes, like, because it's being advertised, everybody think they're entitled to it.
Mm-hmm.
They think, they're entitled to down payment assistance, and it's like sometimes, people don't understand that you may not even need it, because you are putting yourself more into a situation where you're putting yourself, how should I say, you're limiting yourself, because some of those programs I see, you have to stay in the house. You can't sell the house within this amount of time.
Pay back the grant, yeah.
Or it adds on to your mortgage. So you're essentially paying for that, when sometimes people don't even need it.
Right.
They just feel like because, I'm a first-time home buyer, I'm entitled to it. And,
Right. Yeah. You said one important thing, and that you mentioned that why some of they might make too much.
Yeah.
Right. So, if you make in certain ones, you could be at 100. The most one we have goes up to 140,000, I believe. That's the Shinoa one. That's the 0 down one. And then, IDA has one. It depends, like up to 140, 125. And some of the IDA grants are not bad, because again, they have one that you don't pay back, but you have to pay it back if you refinance. And again,
right,
we're going to be in a refinance market. And some of you guys might say, well, that benefits us. It does, but it benefits me more to help you save you $200-300. It benefits you more for you to save $200 or $300 more. Does it benefit us? Yeah, I mean, as a lender, we keep 90% of our mortgages. So do we? If we're talking about profit, do I make more if your rate's higher? Let's say, like, if I'm a lender, right, and you're paying us every month, and your rate's 7.5, I'm making more interest, right?
Mm-hmm.
If I'm getting 6.5, I'm making less interest.
Exactly.
Yeah, so I'm encouraging you to pay less interest.
Right.
So that's the difference there. Go ahead.
And I got a question. You said we're about to become into a refinance market. How do you think the rates? Because it's still sellers that are on the fence about selling because they got those rates at 3%, and you know the rates are predicted to go down to what, 5%. So you still have those sellers that are on the fence. They want to buy, but they feel like they don't want to pay more or come into this market where they have to pay more because their interest rates won't be 2.5 and 3%. So
I love that. So we're going to show, I want to show I think I sent you the link to sign up. I'm going to show this link here in a second that talks about wealth building. We're going to navigate. I'm going to have Demond help me out a little bit. So the thing is, this is through Moody Analytics. It's going to show you what the values of homes and things are expected to go. So I think we have a big issue, and you know this. Inventory.
Right.
You've got a lot of people you're working with that are pre-approved, ready to go, and you're negotiating and things like that. So inventory is low. When these rates begin to come down more, you need to probably put more houses on the market because, to solve that inventory issue, we need to have more houses. Now, if somebody's at a 3% interest rate or a 2.5% interest rate and they want to upsize, not downsize, those rates, I don't know what that sweet spot is. We don't know the matter. It might be 5% to get their dream home, right? They're going up double. Right? A little, it might be. So if we're in the fives, right? And maybe they can pay down points. We can do seller buy downs to get into that. You're talking about, you're in a situation where it may be this week. So like for me, and I'll tell you, we love our home. My rate, and I always use my rate's 2.625. I probably will never move. Even if, let's say all of a sudden, Christian, we just powerhouse and killed it over the next 3 years, and we're making ridiculous amount of money. And I'm like, okay, I want to buy another house. Maybe I'll keep that house and rent it out because it's. But I might decide, at that point. But if someone really needs to upside their house, they don't have enough room, then I think they will move in that low to 5 rate. In the range. So, but there's ways to get around it. You can do buy downs. You can do permanent buy downs. Right now, I don't think it's a good idea to do a permanent buy down because they're on their way down. Right. We can do 1 year buy down where we cover it, but you get creative as far as, what's the most important thing to you. I'm going to answer Teresa's question in a second. I think she said something about home equity line. So when we're looking at your sellers, I definitely think they should be talking to you. Talking to your agent and figuring out, okay, you've got buyers that want to buy, right? So what's the, if I'm at a 3% interest rate and the rates are in the mid fives, let's say by the end of summer,
right?
Can you potentially ask a seller to give a credit or add a credit to buy down the rate to 4.5? So it's not that big of a difference. Or can we pay off a loan with all that equity you have, right? Because you got a ton of equity now, right?
Right.
So can we pay off a loan that makes the payment close? So there's ways we can get creative. There's a lot of creativity there. But I want to ask Teresa a question, and I definitely want you guys to ask Christian questions because she is a powerhouse agent that's doing really good things in this market. There's some agents. I know a lot of that's not selling right now. She's doing a great job. Teresa's asking, what are the ramifications of requesting a home equity loan? I don't necessarily know there's ramifications. I mean, the lines of credits are a little high. I've seen stuff at 9.5%. You might be able to get your bank to give you 8.5%. I've seen some at 12, 11. As long as you have equity, you can tap into it. Say if you want to say what's the negative part. I mean, I have a line of credit that we have. So but if you want to sell your house, you have to pay back the line of credit, right? You can use your line of credit to help you buy other property. I've seen people do that. Tap into the equity, not sell it, and then use that to buy property. So I don't know if you can do a follow-up question, Teresa, let me know. You want to take, let's see.
I believe those truly know how to maintain a home.
You need one. Are paying $1,500 or more should make an effort to do that for themselves and their legacy. It's like when you say do that, are you talking in terms of just knowing all the information that's out there?
I think he's saying to basically maybe add value to the house or keep the property up.
Oh, talking about for the home equity? Well, that's two separate questions.
Okay.
Yeah, so you follow up with that for me. I think that's Antonio that's asked that question. Follow up that for me. Ali. Teresa said home repairs. Yeah, I mean, you want to take this one? If she's using the money for home repairs, like if you're going to sell her house eventually, would that add value?
It definitely would add value. It definitely would, and then it'll be more of a smoother transaction. Sometimes sellers, they have all these, they want to sell their properties as is, And the truth is, it can't be as is if it has so many issues. So that makes the transaction in itself more difficult, and it makes it difficult for you to sell your house and get the money that you need. So I definitely would suggest to do all of that upfront, even before putting it on the market. Just do what needs to be done so you can get the money. You're gonna recuperate the money back.
Oh, she's not one to sell. So you're just talking about updating your house. So yeah, you could do this in a couple ways. So you could do a line of credit. It also depends on your rate. We offer renovation loans as well. So if you want to do a 203K or a home style renovation, which is a conventional rehab, there's things to do that. Or if you want to rent it out and keep it, renovate it, keep it, and then buy another one. I mean, there's a lot of things you can do that. Lines of credit are cool for people because they're interest only payments, so they're affordable. But here's the key about lines of credit. So I'm gonna bust that myth too. You know, the rates are higher. You got to pay. It's interest only for 10 years. Then you got a 20-year on there after that. You need to send more. You start making principal payments. Don't make the minimum payment because you'll have that line of credit for a long time, and that bill is going to come due. So that's the difference with lines of credit. Nothing wrong with doing it. Like I mentioned, I have one, but you know, you can use the that money to help you build more wealth. That makes sense. So, and I appreciate everyone jumping in. Again, Brian Sewell here from Cherry Creek Mortgage, the division of Guild. I got Christian Willis here from KW. Which office are you out of?
I'm on the north side.
Okay,
so
but you serve
KW1 Chicago. So we're a division of Keller Williams. I serve Chicagoland and surrounding suburbs.
Okay, yeah, and you're, I mean, all over, right?
All over, but most of my clients are pretty much Chicago and south suburbs, southwest suburbs.
Okay, cool. Yep. So you guys heard it. She's giving you some good information. We're spitting some truth out here. Any other questions there before we jump on to the next thing here? Where are we at? We're doing really good on time. So, Damon, let's go to this this building wealth piece. Anything else you want to add before we jump on?
No.
Okay. Let's talk about this building wealth. So I want to show this. To me, it's all about education. I make the promise, you know, I'm going to educate, I'm going to encourage, I'm going to empower. My philosophy is this, and this is just, and I'm going to tell you where I can, and I'm not everyone's cup of coffee. But here's the thing, you know, I watch too many movies, but one of my favorite movies is Cinderella Man, and I haven't seen it in a while. So it's about this boxer. I think Russell Crowe played in it, right? And you know, he had to get help, right? He needed some help. When I watched the movie, remember, he needs help. He fell on this, he got treated bad, fell on bad time. But then he got right, and when he got right, he went back and he paid that money back. You know, and it's something like and I look at it as term that I believe in giving. I believe God blessed us to be a blessing to others, right? And so when we talk about real estate, which is one of the largest vehicles you can use to help build wealth, you know, I want to make sure that we know all the information out there that can use. Like again, I think it's for people that really need that assistance, get the assistance. I'm going to show you another grant that we could talk about that I think you will like a lot, because we'll do a combination grant that I think you can put up there. I think it's pretty cool. So look, can we open that up a little bit? I want to just show an area. We're going to just do one in Cook County. So what this is one of the tools I use is through MBS Highway. It talks about why it's important to buy versus rent. And we're going to use a lot of calculators here. So I'm going to do a typical purchase price here. You got the right, you're good with Cook County. So let's put a purchase price of like $350. Okay, I just want to, because that's what we're seeing that's out there, and we're just going to show you what this looks like. And then anyway, we can make that a little bigger, then hit that button. So look, so we're going down. So I want you to open up the renter, that little renter button that's over to the left. Okay, so what this shows you, and this is Moody Analytics, not my data. This stuff is really cool. It's on-time data. This shows you the average rent. It's about $2,800. Oh, my eyes are getting better. I don't even need my glasses.
$2,800 on a $350,000 house.
Yeah, okay. That's what the average rent is. Okay. So the difference between someone paying rent and someone buying a home. Let's talk about this, right? So if we said it says $2,782, we'll just say $2,800. You multiply that by 12, that's about $33,600 a year. Okay. If you did, we're going to do this for 9 years because I like looking at things long term. That's $302,000 in 9 years, the money you've thrown away if rent doesn't go up. Come on, go down a little bit over where it says annual rent increase over there to the right there. And you see it says 5.9%. So we're not going to even use that calculation. Average rent increase is that much. When you purchase a home today, and we're just typically looking at rates, I think, go down a little bit more for me, Damon, to the left. A little bit. Hit that loan button. The orange one, yeah, that one. So right now, the average rate 6.75. So that can vary, it could be lower, mid. All right. So when you talk about that, come back up. what the average mortgage payment on something like this would be about $2,043, versus rent. Then you add your taxes and insurance, you're about $3,000 a month. Okay. So that being said, main benefits of owning a home. And is when you talk about that. So cash flow compared to rent over a 9-year period is 52,000. Appreciation right there says 3.16%. Can you hover over that a little bit for me, Lamont? Go right under the 112,914. That green button. Yeah, just hit 3.16%. Right on it. No, go right underneath that. The third number. Yeah, that one right there. So we're using 3%. But I'm gonna tell you something. That's being conservative. It's just taking all of Cook County. Some areas are going up 5-7%. So over a 9-year period, you would have gained 112,000 in appreciation, 113 almost. The other part, I got this from a renter the other day. This is kind of funny. Over a 9-year period, you would have paid down 40,000.
Right.
Okay. He's like, that's not a lot of money. Over 9 years, that isn't a lot of money, right? That's like, what's the exact number on that? And I was talking to someone about this. I thought it was so funny. And I caught it. So that's about $3,300 that you're paying down on a 30-year mortgage. That's why Dave Ramsey said 30 years is criminal, but paying rent is criminal, right? So 40,000 you'd pay down over 9 years. How much did we say he paid over 9 years in rent?
You said he paid.
It was 300, wasn't it? Was it? It was 2792 times 12 times 9. It's 301,000. So 40,000 positive is still better than throwing away 300.
For sure.
And what this number doesn't include of being able to write off property taxes of 10 grand a year and all of your interest. So go ahead, go down for me a little bit. Come on. Now I'm showing it before we hit show results. I'm just telling you what these numbers mean. Okay. I know that some of y'all don't like math class, but I think this is really important when you're buying a home. When you look at the cost to sell a home, we're just going to assume that it costs you 6%, pay your closing costs. We're taking these numbers in consideration. Hit show results for me. We're going to calculate this on a. So this is how you build wealth. This is how you break the wealth gap. Okay. Over 9 years, even after you sell your house, if you decide to sell to keep, in this particular situation on a $350,000 house, you would have built your net gain, your value of who you are, cash, 170,000. So I'm going to ask people this: if whoever want to join in, is it easier to save 170,000 over 9 years? I mean, I know some people can do it,
right?
But is that easy?
No.
That compared to what we just did here, we probably put 5% down, 3% down. I'm not telling you guys to put 50% down. I'm telling you, maybe you put a little skin in the game to help you. So this is what I mean about building wealth and how we can use that. So we can take that screen down, but I just want to address some of these things and just help. That part is a little boring. I know people look at it like, but we can show this specifically for every client what that looks like. So what are your thoughts on that? I mean, you look at those numbers at 170,000 being built up like that.
Yeah, that's the reason why I want to help people purchase a house and get into real estate. Yeah. People are not educated on, how they are losing money by renting, and it's no benefits that come with that.
None. So, I mean, you get a benefit. You got a home, right? I mean,
you got a roof
right, but
it's not any long-term benefits. If you get in a situation, you have equity in your house, you can potentially pull the equity out, or you can sell your house.
Yes.
When it comes to renting, you can't do anything.
Yes, 100% agree with you. And it's so much that people don't look at. And that's our job, right, Kristen? We think about it. It's our job to try to educate as much as we can so we can make the best decision, help you make the best decision. Okay, so we got a couple more questions. He said, in terms of renting, if they're paying, what does that say? Urgent rental costs. That you're getting big words on me. I don't think I've ever used that language before. Want or need a home, should make the effort to get information on buying and maintaining a home. Okay, yeah, you're right. Yeah, so that's the key, right? You got to. So many people are discouraged. I mean, I know you run into this.
Yeah, of course.
So there's hope. There's ways around. Like with some of these grants, the closing costs are higher on them. You could ask. I mean, you could help. As far as you ask for closing cost credit, sometimes we can offer a lender credit, to help offset some of the money you think you were getting and you're not paying us back. I'm going to bring up this grant and share this with you. So it's like three main cool things about it. It's called our Advantage program, where basically, you got to be at 80% of the average median income. So if the average median income is 100,000 in the area, your average income can't be over 80. That's easy math. I like easy math, right? So we go up to 2%, up to $5,000 on the grant. So if you bought a house for $250,000, 2% would be $5,000. So as long as you make 80 or less and you can go conventional, There is a couple benefits we give. We give you 5,000, pay us 0 back.
Okay,
5,000.
cool.
That's 5,000 grant, right? It's fully forgiven. You
Okay.
refinance in 6 months, you're not paying us nothing back for that, right? The second thing we do with that is we lower your rate by 1%.
Okay.
If you make, again, you got to fit in this bucket is 80%, which a lot of the affordability part is really cool. This is why I said $5 grand you don't pay back. It doesn't. There's no, there's no catch. You don't have to pay the $5 grand back after 8 months. You decide to sell your house, something comes out, you don't pay it back. We buy down your rate by 1%. So if the average rate is 6.75, you're probably at 5.75 that first year, depending on your credit score, because it does go off the credit, right?
Okay, I like that.
And-
And they can go conventional.
And it's this conventional, yeah. So
Okay.
so the $5,000 grant, you buy the rate down by 1%, rate's going to come down. You can take advantage of refinance it, and we do payment protection. Write that in there, the payment protection. What that means is rates come down, you do not pay a lender cost to refinance.
Okay.
So that saves you some money there. So there's ways that you can, you can do grants and still actually get a grant and not have to pay it back. So, and then we got a couple other programs. We had another guy that took advantage of this program. It's called our Home Depot program, where we bought down the rate, and then we gave them a $1,500 grant, and they got a $2,000 Home Depot gift card at the closing. So yeah, that's a conventional product too. But again, you're not paying back the $2 grand. You're not paying back the $1,500.
Okay.
That was on a $140,000 condo.
Okay.
So I mean, there's ways you can do things to get into properties and not have to pay it back. So that's what I mean about helping people get into a home or helping them get a loan. That's just not fast talking. I'm not taking shots at people or just let's just throw them in there. No, if you need to take a breath and take your time and do it, but you're in the market, Christian, you can talk about this. If you see a house you fall in love with, what do you need to do? If you need to move, right? Or
yeah, you need to make an offer.
yeah, I mean, you have time. You have the attorney review period, right? You want to explain that a little bit, like what that looks like, because
yeah. So like if you're buying a house and you put an offer in and you're not sure about the house or something comes up and the numbers are not making sense, you always can back out of that deal. You have 5 days legally to back out of that deal, at no cost.
Yep.
So yeah.
No, I love that. All right, so we are open it up to more questions. Anything you want to share? And I got Christian Willis. I really appreciate you being on the show. It's our first day back. It's kind of cool to be back here and busting some myths, right?
Mm-hmm.
We talked about some cool down payment. We talked about some maybe not so cool. And again, buying a home is a good deal. I just showed you the equity you earn, right? That's a good opportunity.
Yeah.
It's not. I don't want you to get discouraged, but I also want you to be educated.
Of course.
It's
and I think even going back to what you said about the renting, like everything that landlords are like starting to require, like they're requiring so much, like they want to see bank statements. Like I was at a building the other day, they said they screen their tenant. When they screen their tenants, they have to have bank statements. They're really strict. Like you have to have a 640 or higher credit score, and they mean it. Like you can't have, it can't be lower. So I just think you have to have all those qualifications to buy a house. You're
almost buying a house when you rent, right? Except for you're not getting the benefits.
And then sometimes they want first month, last month, so
security.
So you're putting so much into something that's not even yours, and you have all these requirements when those same requirements is to buy a house.
Well, then the other things I remember about renting, so my first apartment was not too far from the radio station. We was in Alsop, right? And I'll never forget. This is 20-some years ago. But I remember, you have restrictions. You just can't paint when you want to paint.
Right. You can't do any of that. You can't mount a TV. If you mount a TV or if you paint, you got to paint the wall back.
Yeah.
You got neighbors.
Can't have a pet. Well, sometimes you can. Sometimes,
but you got to pay to have a pet. You got to pay for parking. You know what I'm saying? So you got to pay for laundry. Everything costs.
Somebody got some loud music next to you. You can't. I mean, you can buy a condo, still the same thing. But you can complain there. But you get an advantage of having it be your own. It's nothing like having your own home.
It is. And I definitely advise people to do it when they can afford it and when they're ready, and to do their due diligence and just don't jump on. And everybody's situation won't be your situation, right? Because people come thinking, oh, well, my friend got this and my friend got that. Well, everybody's credit, everybody's situation is different. So
a lot of times people won't tell you that too, and that's why I always ask probing questions. Some of you, I'm a little nosy. Like out here say, "Oh, my family had this same couple going back a couple weeks ago. My sister said they didn't have to put no money down when they bought their house."
Right.
Okay, how long ago was that? 1. Okay. Number 2, what's their interest rate?
Right.
And they would say, "Well, she didn't tell me about the rate." Well, that matters.
Right.
You know, if I told you that, hey, I'll get you to a home and you only need to bring $3,000 clothes, okay, and your payment's 2,500. Well, I told you in that same home, I get you in a home and you have to bring like $9,000 clothes to make this number up, and your payment was 1,700 or 1,800. Which one is the better term for you?
Mhm.
And it just shouldn't be automatically the 1,800, y'all. I'm just messing. It should be, okay, how much do I like? What can I afford to bring that money? But then the other thing is, what's the term? Do I have a balloon payment? Is, am I going to be able to refinance that property? So that's where, to me, you got to be able to ask what the terms are. What does it mean to get into this home? Like, how is this going to affect me financially?
Yeah.
One of the things that my stepdad taught me, this is years ago, he passed away about 3 years ago, but one of the things he taught me is write down the advantages and disadvantages of every situation you make. I mean, I learned, I truly believe in education and encouragement. I remember I used Rick Ruby, as he was one of my old coaches. He would always say, take 48 hours before you make a big financial decision. Just write it down. Write down advantages and disadvantages. Even though we got these out here, I love phones, but I'm writing stuff down. I'm gonna write it down. Say, hey, these are the benefits. These are the disadvantages. Disadvantages. Right? What does that look like? People really need to focus on their credit scores. You want to answer that?
I want to kind of go on that because everybody thinks, and I appreciate you for commenting, but everybody thinks that it's all about credit scores, and it's really not. Honestly, it's other parts that play in getting approved to purchase a house. So it's not just all about your credit score. It's also about, and you can back me up, your debt to income.
Right.
So a lot of people have a lot of debt. You can have a great score, but if you have a high amount of debt, then you're not going to get pre-approved, or you're not going to get pre-approved as how much you think you will if the income is not there as well.
Yeah, the debt to income ratio is a big thing. I mean, he's right about, or she's right about the credit.
Of course.
Yeah, but the debt. So if you talk about that, Christian hit a good point. Let's say you make 60 grand a year. So I'm using my easy math for y'all. That's $5 grand a month. A 50% debt ratio is 2,500. Okay, that's at 50%. That's before Uncle Sam takes their money out.
Mm-hmm.
So we're literally so a person that's making that type of money that makes 60 grand, they might, out of the $5 grand a month, they might get 3,400. So then we said they can afford a $2,500 mortgage, in some instances, or plus taxes and insurance. I mean, not tax insurance, your card, or any other thing. So it does matter. One of the questions I like to ask is, what's your comfortable? Where do you feel comfortable? Mm-hmm. And then I shut up and listen.
Yeah.
And I hear couples all the time, well, we didn't really talk about that. Well, let's talk about it. Mm-hmm. And then easy math for you too. And it's a little better now because the rates have come down, but 1%, if you're in the suburbs, or whatever your loan amount is, generally what the payment is. And what that simply means, if you're buying a $300,000 house, it's $300,000 loan, 1% is going to probably be but $2,800, $3,000 on the payment.
Right.
That's in the suburbs. Now it's going to be a little less now because the rates are coming down. In the city, it's probably going to be typically a couple $200-$300 less than that, maybe $400. But the key with the city too is that everybody's raising their taxes now, so you got to be careful. So we look at those numbers. What did he say? If you have a really high debt, you won't have a good credit score. That's not always the case.
Right.
I've seen people that I've looked at a lot of loans that where, man, the credit was 750, 760, but they just couldn't qualify for what they really want. Because what they don't know about, like on your debt, they don't know how much you make. And here's a good example of that. Let's say I got a self-employed borrower that makes 200 grand a year. Right. But they write their income on paper showing 40. Mm-hmm. The $200,000 a year guy wants to say, I want to buy a $500,000 house. They only can afford $150,000 house, unless they do a bank statement loan or some weird DSCR loan. If you're paying a higher rate for that too, that's a whole different side. So, taking a traditional way we do mortgages, which again, I'm gonna say this: mortgage stands for burden. The mortgage guy say that. That's what it says. It's a debt that you pay. You want to guess? I don't think I ever told you this. What year do more on a 30-year mortgage does more to the principal payment than the interest payment? What year? So like you got a payment. Let's say you got a $2,000 a month payment. Anybody can participate. What year? I mean, like and principal and interest. How much? What time? What year would you guess that more of your payment goes towards principal than interest on a 30-year?
Is it your first year?
No. The more. No, interest is mostly the first couple of years. It's mostly all interest, right? Remember I showed that number, right? So you don't start seeing more goes towards principal until the 21st year.
Wow.
Yeah, it's still better than rent. Show that screen again, Damon. Let's show it. Let's show it again because I got to go to my boy, and I'm gonna get to Franklin's question in a minute. No, over to the down to the WVTC at the bottom to the left. The rent buy versus rent calculator. It's up there. Yeah, right there. Hit that again. So go up a little bit. Yeah, there you go. Perfect. So $40,000 right there. It talks about the principal that you've paid down over 9 years. That's not a lot. It's $3,300, something like that a month, right? I mean, a year. But it's better than throwing away, in this example, $300,000.
Right.
So there's ways to trick that too, which I don't really believe you should be aggressive on paying your house off until you do a couple of things. And I can get to that in a minute. We got time to talk about that. I'll talk about how to pay your house off. We're going to talk about that subject at the end, how to pay the house off early. But I don't want to get to that right now. Let's get to a couple of questions I think people got for you to answer. I saw Franklin had a question. Thanks for showing that, Jamal. We're good. I just want to show that number again. We had a couple questions pop up. What if you pay your house? Oh, there it is, top. No, I hear it. What are the things to look out for when buying a home? You can get that one.
Some things you want to look out when purchasing a home. It's the way he worded the question.
Like some pitfalls you think it'll help them out a little bit. Like some things you might advise. Like if you're showing me a house, what's some things you might?
Well, definitely anything that's probably wrong with the house. So when I am doing showings with my clients, we're looking at the roof, we're looking at you want to make sure the furnace is good, the electrical is good, the plumbing is good. If you're not an investor, if you're a buyer, you want to make sure you're going to occupy the property, you want to make sure that it's livable and it's functioning. I think a lot of people look at the aesthetics of property now. They look at how good it looks, but you have to make sure that property is functioning, that it can function, and that it's livable versus what they did, how they customized the property. When you walk up to the property, how does it look on the outside? The area, you want to look out for the area. You're going to be living in this area. So that's going back to don't just look at the aesthetics because you have to live in this neighborhood. How do the neighbors seem? How is the schools? Is this a good school district? Do you want your kids to be in a good school district? I think a lot of people don't really do the research that needs to be done when they are wanting to purchase a house. They don't think about those things. They just kind of think about, how good the property looks. And it's so much more that go into that.
You're preaching location.
Yeah. Is this area appreciating in value? Is this an area that's appreciating? Because if it's appreciating in value, then that means you're going to have equity in your property. So it's a lot of things that you want to be on the lookout for when you're purchasing a home. Besides what the property looks like, it's so much more because this is truly an investment. So you have to think about it like an investment and long term versus what it really just looks at.
You just hit on all those things. He just said, he said foundation, roof, windows, it's all the cosmetics. So you talked about, but then what did you say about the school? I mean, you just hit that.
The school district.
Yeah.
A lot of people don't,
Thank
talk
you,
about the school district. And,
yep.
If you have kids or if you're planning to have kids, those are things that you want to think about when making this investment.
That's good.
Crime rate as well. Yeah, you definitely need to think about the
you say
that's what I meant by saying location that, you have to.
Well, resale value, I mean, that's the thing, right? That people look at that. They study, they tell it, like, so what am I going to be worried about?
Right.
It's right for your kids. So it's so important. Here we go. So that's true. I knew someone who bought a $300,000 house, but it had water damage and no installation. Wow.
Then they probably didn't.
Home inspection?
A home inspection, and then now I'm advising people even when they get a second home inspection, not one that's such as thorough as the first one, but you're not in that house. If that house is vacant, nobody's living there. Even if somebody is living there, you don't know what's to happen between the initial inspection and the day of the walkthrough. So you want to make sure you cover, you crossing your T's and dotting your I's and making sure that the inspector and that you're picking a good home inspector that knows what they're doing, because it's only going to cost you being a buyer in the end. It's not going to cost the home inspector.
Right.
It's ultimately on you because that house is your responsibility.
I mean, I think you hit a home run there because, so many times people may not want to spend the $300, $400, $500, whatever it is now for home inspection. And that can save you thousands.
It can.
It's so important that you're investing, and you're getting a good property. I mean, I got a client right now, that is he's dealing with a slumlord, and one of the things he's like, I got to get out of here. I said, hey, do the app, we'll look at it, but but they're getting water damage. They live in like the basement apartment. Getting and the landlord said, I'll fix it when I fix it. So electric's not working, so all that stuff plays a factor. And you're renting now; he can't do anything about it. But complain. So,
and that kind of goes back to location, because some villages, some areas, they deal with water damage versus others.
Right.
Or you may have a flood zone or something like that. So it's really good to do the research on a village as well. Like, how quickly does the village, how are they taking care of things? You know what I'm saying? Stuff like that. So that kind of goes with location as well.
What you said about kids, I love what they said right there. So you're right. Some people think it's just me. Right. But Reese, if you're the agent, you're coming to sell my house, is it going to be easier for you to sell a property with 3 bedrooms or 2 bedrooms?
Definitely 3 bedrooms.
Yeah. Yeah. So that's good. It's good information. Let's go up to that credit score one. And I want to hit the one about paying a house off early too. I think you said something about, somebody having a 522 credit score. Yeah. Yeah. So that is so important. I mean, they know, because I have people that make a lot of money. Now I'm gonna talk about some of my doctors, you are, and they don't pay their bills. So not all of them, right? But at the end of the day, if your credit does affect what you're able to get as far as the rates and stuff concerned.
Definitely.
But what Christian said earlier with the debt ratio affects it as well. There's a thing called risk-based pricing, and I don't want to get into lender jargon, but basically how it goes on a conventional loan, that is, and it's some is on FHA. If you're under a 740, there's a hit. The hits mean your rate's higher. If you're under 720, there's a hit. If you're under 700, there's a hit. So they analyze the risk, and I can keep going and going and going. All right. So having a good credit score does impact you as far as buying a house, but not just buying a house, buying a car. I mean, getting a credit card. Why would you want to pay more interest just because?
Because I see a lot of and I'm not trying to throw nobody under the bus, but I do see a lot of people that advertise, and I know they're out there too, because I work with other lenders, of course, and they do have those programs where you can have a 580 credit score, and I've never advertised that, because I just feel like if you can have a 620 or higher,
you get a better deal.
You're getting a better deal, and it's not that hard of a reach from 580.
So let me touch on that, because we go down to 540 on FHA. You never hear me talk about that, do you?
No, I know.
Right? People don't. Y'all do that? Yeah, we do. And I helped a veteran that had a 555, 560 credit score. I forget that. Not that long ago. He get into a home, but the key is there's overlays. Everybody say overlays. You want to type that? Type that in. I'm gonna have fun. Like overlays, right? So that means if your score is high, so you're gonna pay a higher rate, right? And overlays is okay. All right. Do I have any lates in the last 12 months? Right. You might with a 522 credit score,
right?
Yeah, right. 540, right? Collection. So can I verify rent? Oh yeah, I pay rent on time. Oh, I'm paying cash to my mom. I can't count that.
Right.
So their overlays is prevent you from buying a home. So, and you're going to be paying a higher interest rate and more points. We don't talk about that. They just say 540, get a house, right?
Yeah.
It's sexy. It's funny, right? It's cool. It's jazzy. It gets people. It gets views, right? It gets clicks, whatever you want to call it. But if I help you build wealth, oh God, you just want to go down that route. No, I want to help you in the long run. I want to help put you in a better financial situation.
Yeah.
And that's where we do it that way, But yeah, we go down to 540 FHA, 10% down. We go down to 580 normal, 580 is the approved eligible, and then 540 for VA. So let's hit that. Let's hit that. The other question about buying a home. I do want to. And Krishna, I appreciate you. You just show us flying by. I hope you're having fun.
It's cool. It's cool.
All right, you gonna come back on?
I will come back.
All right, cool. Look, I'm asking you on the spot. See how I do? I ain't gonna ask you that off there. You're like, man, listen, I'm not messing with you. So look, Franklin, great question. So I used to believe this, right? I want to pay off my house. I can get you took the question. I can't see it. Going too fast. Okay, read that. What if you want to pay your house off or put a big payment to get a lower pay? Absolutely, you can do that. I look at cash flow, though. Okay, what does it look like? So you got to ask your question, and I'm gonna get to the other thing I want to get to. I'm gonna try to get to it fast because we only got 6 minutes. You ask your question. What's my goal? What do I feel comfortable with a monthly payment? Okay. So if putting down 50% makes my payment more comfortable, then that's fine for you, right? Okay. But if you're good at 10% or 5% or 20%, whatever it might be, and you can invest that money in savings and investment account, then do so. So I should have coined this term. I used to say this all the time before I got coached over 10 years ago. I used to say 2 and 18. So I'm going to show you how to pay your house off fast for those. And Dave Ramsey talks about getting 15-year mortgages, paying stuff off. I like Dave a lot. I follow a lot of his principles. I don't believe in having bad debt, but I do believe that this thing called time, right? Christian's young, right? Much younger than me. I'm getting old, right?
I'm
But
30.
this time though, long-term investment, we got compounded interest, compounded payments. So I'm gonna talk about the money theory. So what I used to say, and this is how you get coached and change your mind, is that you could pay your house off in 18 years. We called it 2 and 18.
Okay.
One extra payment to principal, knock 6 years off the mortgage. One extra payment, another extra payment around tax time. So 2 extra payments, another 6 years, you're done in 18 years. Beautiful, right? But what if 2008 happened? And we don't expect that to happen again. People think that's the same crash. There's not enough inventory. What if 2008 happened and all these people lose their jobs? Is it easier? COVID happened. People got laid off, right? Is it easy to live in a house where it's almost paid off and the bank won't give you no money? Or have 50,000, 100,000 in the bank?
Definitely to have that equity.
Right. So you need both. You need both. So what I say is this: try to live off 70%. I believe in giving 10%, saving 10%, investing 10%. Compounded interest pay, compounded when your money doubles every 7 years, right? So if you max out your 401k and you put up 10% of your income in a long-term investment, I can get you hooked up with a financial planner for that. In the long run, if you do that, you keep building on that. $1,000 a month, that's $12,000 a year. That's $120,000 over 10 years. Your money doubles every 7 years. So over a 20-year period, you got $240,000. I'm doing math fast, right? But the money you invested, actually, it's $500,000.
Okay.
Just by doing it. And some of us know, we can break up $500, pay or $250. Let's say you do half of that, $500, then that's $250,000 you have in 20 years. So there's ways to do it and build long-term wealth. So I believe you should do that before you try to pay the house off fast, because that's money you get to keep in touch, and that's going on. You have 2 ways of building wealth.
Yeah.
So I talked about that really fast. I'll bring a financial planner to go. But I like talking about that because I get excited, because then we could show. Now, what if we showed you that screen that showed you built 170,000 earlier, and you got a couple $100,000 in investment? Now you're beginning to kill that wealth gap.
Right.
That's how it's long. And notice I didn't say anything about winning a lottery. This is creating your own lottery. Christian, you're going to close us out. So how do you feel? And I appreciate you so much for being on the show with me. I think you did a great job.
Thank you.
Helping me out my first day back, right?
Yeah. Anytime.
Yeah, cool. Any parting words you want to give?
Not really.
Yeah.
Any other questions you have to ask me?
Let me see. I have a question. Come on, Erica. Then get it in before we get off the show, before they kick us out. Thanks, Franklin, for what you said, man. I appreciate you, brother. I have a question. Well, you can't have a question and not say nothing. Come on, Erica, talk to me. I like how your name is spelled too. I'm too late. No, you're not. Keep asking. Get it in. You spell your name the right way too. That's how my wife spells her name. Okay, so what you got? Talk to us. Come on.
Well, I'll just close out and say, real estate is important, and real estate is really important, and I love helping and educating our people.
Yes.
What did she say? If you're married and you file separately from your husband, you each claim a child. Okay.
You get more. Get more what?
Do you get more from your taxes or?
Yeah, that's probably the count. Oh, you mean by yourself buying a house? Well, the more income I have, the more I can qualify you for. Which is a quick answer to that. If you guys are filing separate, and you mean your tax money back, you got to talk to your accountant. But I think only one person can deduct the interest in property tax. But I'm not an accountant, so I can't tell you that 100%. Why are there real buttons on a drive-up ATM? What?
Yeah, you just getting.
Yeah, you being funny now. I don't know. Taxes, sorry. Yeah, so that's an accountant question. You want to ask your accountant who can write off the taxes, the property taxes and all that stuff. But look, guys, I'm going to close real quick. I just want to tell everyone I appreciate you guys for participating. Please tell your friends. I'm all about helping good people, helping everyone become homeowners, building wealth through home ownership, right? And how we do that is by education, encouragement, and empowerment. Never feel like you can't ask a question, right? Never feel rushed. Take the time to breathe. Write down the advantages and disadvantages. I'm so grateful that Kristen came on the show with us, and she gave a lot of good insight. If you want to get a hold of Kristen, what's the best way to reach you?
You can follow me on Instagram, realestate_Christy, or you can, that's the best way pretty much. Instagram, Facebook, my name is Kristen Willis. I'm with Keller Williams 1, so you can look me up on there. Google, I'm there.
Okay, cool. Franklin said answer the questions. I answered that one, Franklin. So no, great job. I appreciate you so much. Guys, if you need, give us a shot to be your mortgage lender. I'd love to talk to you. I'm not going to not give you a 0 down loan. I just want you to be properly educated about it, right? Let's make sure you understand everything so you can make a good financial decision. I'd love to be your loan officer to help you. The best way to get us, to call the line 630-352-0629. Apply online at mytrustedprovider.com. Or you can always email us at teamsewell@guildmortgage.net. So TEAMSEWELL @guildmortgage.net. I'd love to hear from you. God bless you. And we'll be back next week.
Go to your Apple or Google Play Store and download the WVTC Gospel Radio app today. You can also say, Alexa, play WVTC Radio Skills.
Would you like to play WVTC Radio Network?
Absolutely. Download it today.
Views made on the preceding program are not those of WVTC Radio, iNetworks Communications, or their financial supporters.
Winning victory through Christ. WVTC also